There's a man in Atlanta who keeps about $35,000 sitting in his savings account. He's not careless with money. In fact, he's the kind of person most people would describe as financially responsible. Every month, when his salary arrives, he moves a portion of it straight into savings. He grew up hearing the same advice many people hear: work hard, save your money, and your future will be secure. His bank pays him about 0.6% interest each year. That means the $35,000 he worked years to save will earn him roughly $200 in an entire year. Now here's where the story becomes interesting. The same bank holding his savings is issuing credit cards charging 18% to 25% interest. It's issuing personal loans around 9 to 12%, mortgages above 6%. The difference between those numbers is where the real story begins. In simple terms, the bank is paying him a tiny fraction for his money while earning dramatically more by lending that same money out to other people. This isn't a secret, it's simply how modern banking works. And once you understand the system, you start seeing savings accounts very differently. According to financial research and banking data from recent years, the average savings account interest rate in the United States has often stayed below 1%, while long-term inflation has averaged closer to 3%. That means many savers are technically earning interest, but their money is still losing purchasing power over time. Economists sometimes describe this as a silent savings trap. Your balance slowly grows in numbers, but what that money can actually buy may shrink year after year. Banks benefit from this structure because deposits are incredibly valuable to them. When you deposit money into a savings account, the bank does not simply lock that money in a vault waiting for you to withdraw it. Your deposit becomes part of the financial system's lending engine. That pool of deposits is used to fund mortgages, car loans, credit cards, and business loans. Your savings become the raw material banks use to generate interest income. The key concept behind this system is something called the interest spread. The spread is the difference between what banks pay savers and what they charge borrowers. If a bank pays savers less than 1% but charges borrowers 10% or more, that gap becomes a powerful source of profit. Multiply that spread across millions of accounts and trillions of dollars, and you begin to see why deposits are one of the most valuable resources in the entire banking industry. But numbers alone don't explain why so many people keep large amounts of money sitting quietly in savings accounts. The answer is psychology. Savings accounts feel safe. You open your banking app and your balance is still there. There are no sudden drops, no market swings, no scary headlines about crashes or volatility. That stability gives people peace of mind. And peace of mind is incredibly powerful. Banks understand this very well. In fact, the entire structure of savings accounts is designed to reinforce that sense of safety and simplicity. Save regularly, watch the number grow, sleep well knowing your money is protected. For emergency funds, that idea makes perfect sense. Having cash available for unexpected situations can prevent serious financial problems. But the misunderstanding happens when people assume simply saving money in a bank account is the same thing as building wealth. Historically, wealth has grown through ownership of assets that increase in value over time. Businesses generate profits, stocks represent ownership in those businesses, real estate can produce income and appreciation. Savings accounts do something very different. They protect money. But protection and growth are not the same thing. And once you start seeing that difference clearly, the role a savings account should play in your financial life becomes very different from what most people originally believe.